welcome to this deep dive. Today we're unpacking a pretty common strategy in cross-border investment. Using a Luxembourg SOPARFI, that's Société de Participation Financière, one that hasn't actually been formed yet.
Right, the I constitué status.
Exactly, using that to acquire French companies.
Yeah, it happens a lot. So our mission here really is to give you, our listeners, especially if you're in law or finance, a clear and comprehensive overview.
Okay.
We want to cover the whole process, step by step. Setting it up, the really key bits of a share purchase agreement, the SPA, what costs you might be looking at, and crucially, the sort of regulatory and tax updates for 2024, 2025 that you need to have on your radar.
Right. So we'll kick off with establishing the SOPARFI itself, then really get into the weeds of the acquisition, focusing hard on that SPA.
Makes sense.
We'll map out the costs, flag any big regulatory or tax changes coming up, and we need to keep circling back to what that a constitué status means practically at each point.
Absolutely. And maybe the key thing to grasp right from the start is that this whole strategy often turns on the tax advantages a SOPARFI offers.
The participation exemption mainly.
That's the big one. Yes, the participation exemption. So yeah, let's start with phase one. Actually setting up your Luxembourg SOPARFI. What exactly are we talking about here?
Good question. What is it?
Well, look, at its heart, a SOPARFI isn't some unique legal entity in Luxembourg. It's just a standard commercial company.
Like an SA or an SARL?
Precisely. A Société Anonyme, that's your public limited company, or a Société à Responsabilité Limitée, the private limited company. What makes it a SOPARFI is its main job, its purpose. Yeah. Holding and managing financial stakes, participations in other companies. Could be in Luxembourg, could be in France, anywhere really.
Yeah.
And those tax benefits we mentioned, they mostly stem from these holding activities.
And just to clarify, while holding is the main game, it can do other things, right?
Yeah.
Commercial activities.
Oh, absolutely. There's no legal barrier to a SOPARFI doing other commercial, industrial, or financial stuff. But, and this is key, any profit from those non-holding activities, that gets taxed under the normal Luxembourg rules.
Got it. So for our scenario, buying French companies, we're really focused on the tax treatment of the holding function.
Exactly. A SOPARFI is fully taxable in Luxembourg. It pays corporate income tax, municipal business tax, net wealth tax.
Which sounds maybe counterintuitive, but that's actually good.
It is, because that full tax status means it gets access to Luxembourg's huge network of down tax treaties. And it benefits from EU directives, like the parent subsidiary directive.
Ah.
And the real jewel in the crown, as we said, is the participation exemption. If you meet the conditions, dividends flowing up from subsidiaries and capital gains when you sell qualifying shares can be completely exempt from Luxembourg corporate income tax and municipal business tax.
Right, that's the core attraction. Now, when you're setting one up for an acquisition like this, you have that choice, SA or SARL. That seems like a big early decision. What are the main things to weigh up there?
It really is. Let's break it down. The SA, Société Anonyme, minimum share capital is EUR 30,000. And you need at least 25% of that paid up when you incorporate.
Okay, 30K, quarter paid up.
You can start with just one shareholder, no maximum. And a big point, shares in an SA are generally freely transferable. Management's usually a board of directors, maybe a two-tier structure.
And you use an SA WAM.
Often for larger setups. Maybe where you expect more shareholders down the line, or you're even thinking about a potential listing eventually. It offers, flexibility for wire ownership and makes selling shares easier later on. That's a key insight, really. Future scalability.
Makes sense. And the other option, the SARL. Société Responsabilité Limitée.
Yeah, the SARL, it's actually the most common company form in Luxembourg, believe it or not. Lower capital needed, EUR 12,000, but that has to be fully paid up right at the start.
Okay, 12K, all up front.
Shareholder numbers are between 1 and 100, so there's a cap. And here's a major difference from the SA. Transferring shares to someone who isn't already a shareholder is restricted.
How restricted?
Typically, you need approval from shareholders holding at least 75% of the capital, though you can tweak that percentage in the company's articles.
Okay. More control.
Exactly. Management is simpler, too, usually just one or more managers. So SARLs are often favored for, let's say, more closely held structures. They offer more operational flexibility. That's another key insight. Great for tight-knit groups wanting control over who owns shares.
So thinking about our scenario, buying two French companies, maybe starting closely held the SARL might look tempting, lower capital, that flexibility.
It often does, initially.
But as you flagged, you've got to think long-term, haven't you? If bringing in new investors later is a possibility, or you're planning an exit.
Then the easier share transfer of the SA, and maybe its more familiar structure internationally, could be a better bet.
All right. It's not just about day one. It's about the whole life cycle. Yeah. Okay. So we weighed up the SA versus SARL. What's the actual step-by-step process for getting this SOPARFI incorporated?
It's a pretty defined path. First, you need a clear project definition, a solid business plan. Then you nail down that choice, SA or SARL.
Okay.
Next up, check if your desired company name is available. You do that with the Luxembourg trade, and companies register the RCS. It's a small fee, maybe 5 to 10 euros usually.
Simple enough. Then the big one, the Articles of Association, the statutes.
Absolutely critical. This is the company's rulebook. It sets out the name, legal form, registered office address in Luxembourg, what the company will do, its purpose, the share capital amount, who the first shareholders are, everything.
And you need help with this.
You must use a Luxembourg notary. For both an SA and an SARL, it's a legal requirement. They draft and execute the articles.
Right. Notary involved, mandatory. What's next after drafting?
You need to open a bank account in Luxembourg in the name of the company being formed and deposit the share capital. Once that's in, the bank issues what's called a capital blocking certificate. It proves the money's there. The notary needs this.
Got it. Certificate in hand, back to the notary.
Exactly. For the formal execution of the deed of incorporation, just a side note, if you're contributing assets, not cash, to an SA, an in-kind contribution, you usually need an independent auditor's report valuing those assets.
Okay, good point. So the deed's executed, now it's official.
Nearly. The new company then needs to be registered with the RCS. The notary typically handles this registration process.
And then it's public knowledge.
Yes. The registration details and the full articles get published in RESA. That's the Recueil électronique des sociétés et associations. Luxembourg's official online gazette for companies. Key insight there. Notary is mandatory, and RESA is where it gets published.
Okay. Any other registrations needed? You mentioned VAT earlier.
Potentially, yes. If the SOPARFI does more than just hold shares and needs to charge VAT, it has to register with the AED, the VAT authority. There's a mention of a UR75 fixed fee for that.
And a business license.
Generally not needed for a pure holding SOPARFI. But if it plans other commercial activities in Luxembourg, it might need an autorisation d'établissement. That's about EUR50.
Okay.
And of course, if it hires anyone in Luxembourg, it needs to register with Social Security, the CSSF.
You see ads sometimes for online incorporation. Is that really possible for these?
Not entirely. Because the notary involvement is legally required for SAs and SARLs, you can't do it 100% online without that formal notarial step, whether in person or maybe via a secure electronic process. The online platforms mostly help streamline the prep of gathering info, drafting docs before you get to the notary.
Right. So quick recap on core requirements. Meet the minimum capital, have at least one shareholder, get a registered office in Lux, set up management, and that mandatory notary and RESA publication.
That's the gist of it.
Let's talk money and time. What are the rough costs for setting this up, and how long does it actually take?
Costs do vary. You've got the share capital itself, 12K for SARL, 30K for SA, which is more of an investment, really. Notary fees, could be anywhere from, say, EUR 1,000 up to EUR 3,000 or even more. SAs often cost a bit more on the notary side.
Okay.
Then the RCS registration, RESA publication, that fixed EUR 75 duty. Those are smaller, maybe EUR 100 to EUR 1,300 total, roughly.
And if you use a formation agent?
Their fees can be all over the place. A few €100 up to several thousand, depends what they do for you. So if you add it all up, excluding the capital and any really high-end advice, your basic incorporation cost might land somewhere between, let's say, EUR 1,200 and EUR 4,500, plus the capital itself.
Okay, that gives a ballpark. And the timeline? Weeks? Months?
Generally, setting up the SOPARFI itself, you're probably looking at 1 to 6 weeks overall.
From start to finish.
Yeah. The actual legal bit notary to RCS registration is often quoted as maybe 1 to 3 weeks. But you've got the prep time before that, name check, articles drafting, opening the bank account, getting that certificate. That all takes time.
And delays happen, presumably.
Oh, sure. Complex cases, slow information flow. It can stretch out.
Yeah.
Our guide also mentioned a much higher figure, around EUR 28,000, from Healy Consultants for an SERL setup.
Wow, that's a big jump.
Yeah, that likely includes a very comprehensive service package covering absolutely everything. So, key point. Budget, maybe 1 to 6 weeks, and remember the notary and bank steps take time.
Okay, so phase 1 complete. Are A constitué SOPARFI is, nationally at least, set up. Now, phase 2, the main event, acquiring the French companies. And the key document here is the share purchase agreement, the SPA.
Absolutely. The SPA is the absolute linchpin of the deal. It's the legally binding contract spelling out every single term for transferring the shares from the French sellers to our new SOPARFI.
Right. Now, we've got a Lux buyer, French targets. But what law actually governs the SPA itself? Is it automatically Lux or French?
That's a great question, and the answer is it's negotiable.
Oh, interesting.
Yeah, while Lux and French entities are involved, it's actually quite common in cross-border deals like this to choose English law or maybe New York law to govern the SPA.
Why is that?
Mostly because those legal systems have very well-developed, predictable frameworks for M&A. But look, Luxembourg law or French law are definitely options too. It depends on what the parties prefer, the deal specific.
But whatever law you choose.
You need rock-solid drafting in the SPA itself. Clauses carefully tailored to this specific deal, protecting both the buyer and the sellers.
Makes sense. So what are the absolute must-have elements in pretty much any SPA?
Okay, standard SPA building blocks. First, clearly identify who is involved, the sellers and the buyer, which is our Luxembourg SOPARFI. Second, state precisely what is being sold, number and class of shares in both French companies. Third, the price, how much, what currency, how it gets paid.
Okay, parties, shares, price.
Then, conditions precedent the things that must happen before the deal closes. Representations and warranty statements the seller makes about the targets, indemnification, what happens if those statements are wrong, and finally, the closing mechanics, how the handover actually works.
Got it. Now, given our SOPARFI is still being formed at a constituer status, which clauses need extra special attention?
The parties clause is absolutely critical right at the start, because the SOPARFI doesn't legally exist when you start negotiating, maybe even when you sign the SPA.
So who signs it?
Initially, it might be the individuals setting it up, the founders, the promoters. If that happens, you must have a clause saying the SOPARFI, once it's properly incorporated, will formally adopt and ratify the SPA.
Why is that so vital?
To make sure the SOPARFI itself becomes legally bound, and, just as importantly, to protect those individuals who signed initially from being personally liable if, say, the SOPARFI never gets formed or doesn't agree to the SPA terms.
Right, you don't want the founders left holding the bag.
Exactly. Ideally, you time the SOPARFI incorporation to happen just before or at the same time as signing the SPA to minimize this risk. That's a crucial insight. Nail the adoption ratification clause for an ad constituer buyer.
Makes perfect sense. What about the actual share transfer part?
The sale and purchase of shares clause needs to be crystal clear. Exact number, specific class of shares in both French targets. And usually you'll want the seller to transfer with full title guarantee. Meaning they legally own the shares and have the right to sell them free from any hidden liens or third-party claims.
Okay. And the purchase price clause. Always a negotiation hotspot, I imagine.
Always. This clause details the total payment, the currency, how it's paid, and there are different ways to structure it. Could be a fixed price, simple as that. Or it could be adjusted based on the target's performance or assets at closing using completion accounts. Another popular way is a locked box, price fixed based on an earlier balance sheet with limits on value leakage.
Any other structures?
You might see earnouts where part of the price depends on future performance, and escrow accounts are pretty common too.
How does escrow work here?
A chunk of the purchase price is held by a neutral third party for a while after closing. It acts as security for the buyer, maybe to cover potential warranty claims or other specific issues agreed upon.
Okay, useful mechanism. Now, conditions precedent, CPs. These are the hurdles to jump before closing, right? What are the big ones for our SOPARFI constituer buying in France?
Precisely. CPs are the make or break items before the deal becomes final. And number one, given our buyer situation, is the successful incorporation and funding of the SOPARFI itself.
That has to be a CP.
Absolutely fundamental. The SPA needs clear criteria for this. Duly incorporated in Lux, RCS registered, capital paid in, operational bank account ready.
Makes sense. What else?
The SOPARFI is securing the funds to actually pay the purchase price. That's obviously crucial. Then you get into regulatory approvals.
Like merger control, FDI.
Exactly. Depending on the size of the deal and the companies involved, you might need competition clearance in France or even at the EU level.
And Luxembourg's new regime.
Luxembourg is bringing in its own merger control. The thresholds are still being finalized, but look likely to be based on Luxembourg turnover. For this specific deal, new SOPARFI buying 2 French targets, it's probably unlikely to trigger the Luxembourg thresholds unless the French companies somehow have significant existing turnover in Luxembourg, but definitely something to watch for bigger future deals.
Okay. And foreign direct investment screening.
Both France and Luxembourg have FDI rules. Luxembourg's regime kicked in mid-2023. It applies if a non-UEA investor acquires control of a Luxembourg entity doing critical activities.
So is our SOPARFI doing critical activities just by holding French shares?
Probably not if it's just pure holding of French companies operating in France, but the key is the origin of the funding. If the money ultimately comes from outside the UEA, even into a passive holding SOPARFI, you might need to notify the Luxembourg Ministry of Economy before closing.
Ah, okay. So the source of funds matters.
Critically. And separately, France has its own FBI rules, which definitely need checking based on what sectors the French targets are in. So assessing both Lux and French FDI rules is a major due diligence point. Key takeaway. SOPARFI formation, funding, and regulatory nods, merger FDI, are vital CPs.
Got it. Any other typical CPs we might see?
Yeah, usually a no material adverse change, or MS clause, protects the buyer if something really bad happens to the target's business between signing and closing.
Right.
You might also need consents from third parties if key contracts of the French targets have change of control clauses.
Makes sense.
And finally, a bring down of warranties. The seller basically reconfirms at closing that all the promises they made at signing are still true. If not, the buyer might walk away.
Okay, that covers the hurdles.
Yeah.
Let's talk representations and warranties, R&Ws. What's their main job in the SPA?
R&Ws are factual statements the seller makes about the French targets. Covers everything: financials, assets, contracts, staff, lawsuits, tax, legal compliance. A huge range.
And they serve two purposes.
Exactly. First, they force the seller to cough up detailed info during due diligence. Second, they give the buyer a legal basis to sue for damages after closing if those statements turn out to be wrong. So, key insight. R&Ws drive disclosure and create grounds for claims.
And since we're buying French companies, these R&Ws need to be French-specific.
Absolutely crucial. They need to be drafted carefully, reflecting French law and business practice. Otherwise, they might not give the SOPARFI proper protection. This really highlights why you need good French legal advice for the due diligence. And you'll usually see a disclosure letter from the seller alongside the SPA.
What's that?
It lists specific exceptions to the R&Ws. If something is properly disclosed there, the buyer generally can't claim for breach of warranty on that specific point later.
Okay, so check the disclosure letter carefully. Then there's indemnification. What does that cover?
Indemnification sets out the buyer's remedies if the seller breaches the R&Ws, or if specific pre-agreed risks actually happen post-closing.
And there are limits.
Usually, yes. Financial limits, like a total cap on the seller's liability, maybe a de minimis threshold so you can't claim for tiny amounts, and often a basket or deductible the buyer absorbed losses up to a certain amount before claiming.
And time limits, too.
Yes, there'll be deadlines for bringing warranty claims, often different lengths for different types of warranties, like tax usually being longer.
Okay. What about the gap between signing the SPA and actually closing the deal? How do you make sure the sellers don't mess things up?
That's handled by pre-completion covenants or conduct of business clauses.
Right.
These basically oblige the sellers to run the French targets in the normal, ordinary way during that interim period. No big, unusual actions like selling major assets or taking on huge debts without the buyer's say-so. Keeps the business stable.
Makes sense. And finally, closing itself. What's in that part of the SPA?
The closing clause covers the practical nuts and bolts, specifies the date, time, location, physical or virtual, for the handover. It lists exactly what each side must do.
Buyer pays, seller hands over shares.
Pretty much. Buyer pays the price. Sellers deliver everything needed to transfer ownership, sign share transfer forms, share certificates if they exist, maybe resignations from the current French directors.
And disputes.
The SPA will also state which country's law governs the agreement, as we discussed, and how disputes will be resolved specific courts or maybe arbitration.
Wow, okay. That SPA is a beast. So much detail. Given all that, what's a realistic overall timeline for a deal like this?
Timelines can really vary, Depends on complexity, how smooth diligence goes, how tough SPA negotiations are, regulatory holdups.
But roughly?
You can break it down. Phase 1, prep and SOPARFI setup, we said 1-6 weeks for the SOPARFI, plus maybe initial ND-LOI talks. Phase 2, due diligence on the French targets could be 4 weeks, could be 12 plus Vs, depends how deep you go.
Okay.
Phase 3, SPA negotiation and signing, maybe 2 through 8 weeks, often overlaps with late DDL of Phase 4. Satisfying those conditions, precedent, this is the really variable bit, regulatory approvals can take months sometimes.
Right.
Phase 5, Closing happens once all CPs are ticked off. So, overall, you're probably looking at somewhere between 3 and 9 months from start to finish. But honestly, it can easily take longer. Key point. Cross-border deals are rarely quick. 3 9+ months is typical. CPs often dictate the pace.
Understood. Good dose of realism there. Okay, we've got the SOPARFI set up, the acquisition process mapped out. Let's talk about the practical side again. The costs. What should you budget for?
Yeah, understanding the costs is absolutely vital. We covered the SOPARFI formation costs earlier, capital, notary, registration fees, maybe agent fees.
Right.
But the costs for actually acquiring the French companies are usually much, much higher.
What are the main buckets for those acquisition costs?
Biggest one is often legal fees for the Buyers Council. They do a lot coordinating diligence in Lux and France, drafting and fighting over the SPA, handling regulatory filings, helping with closing.
And fees depend on?
Complexity, scope of work, how hard the negotiation is, which law firm you use, how many hours they clock. It adds up fast.
Okay, legal fees. What else?
Financial and tax due diligence fees. You'll typically hire accounting or audit firms for the financial DD, checking the books, quality of earnings, net debt, and tax advisors for the tax DD compliance checks, risk spotting, structuring advice. These aren't cheap either.
Any other advisory costs to factor in?
Quite possibly. If you use M&A advisors or investment bankers, they'll have fees, often a retainer, plus a success fee based on the deal value. That can be significant.
Right.
Depending on the target's business, you might need specialist consultants, environmental, technical, HR, IT. Then there are potential regulatory filing fees if FDI or merger control filings are needed.
Or if you travel.
Exactly. Travel for site visits, meetings, closing, courier costs, maybe translation fees, fees for the virtual data room used for diligence. It all adds up, and while it's not your direct costs, remember the sellers have costs too and might face French capital gains tax, which can influence the negotiation dynamics.
So the bottom line is the total transaction cost will dwarf the SOPARFI setup cost.
Almost certainly, yes. Those advisory fees for diligence and the SPA negotiation are usually the biggest chunk of non-capital spending for the buyer.
And their ongoing costs too, right, for the SOPARFI?
Absolutely. Don't forget the annual running costs, domiciliation fees for the registered office, accounting and tax compliance fees, the annual net wealth tax, maybe audit fees depending on size. You need to think about the total cost of ownership, the TCO, key insight. Acquisition costs, legal, DED, advisory, usually far outweigh formation costs, and don't forget ongoing maintenance expenses.
Okay, super important point on budgeting. Right, let's move into the final phase. Key regulatory tax updates, strategic points, focusing on 2024-2025. Let's nail down how that Luxembourg participation exemption actually works for holding French shares.
Right. The PEX, Article 166 of the income tax law. It's the main reason for using a SOPARFI often. To get dividends from the French subs or capital gains from selling their shares, exempt from Lux CIT and MBT, you need to tick several boxes.
Okay, what are they?
First, the parent or SOPARFI must be a fully taxable Luxembourg resident company, which it is. Second, the French targets must be qualifying subsidiaries.
How do they qualify?
They usually qualify if they pay French corporate tax, which is seen as comparable to Lux CAT, or if they're covered by the EU Parent Subsidiary Directive, which French SAS, SAS, RLS generally are.
Okay, so SOPARFI is parent, French companies are qualifying subs. What about the holding itself?
Two angles here, size and duration. Size. The SOPARFI needs to hold at least 10% of the French subs capital, or alternatively, the acquisition price must be at least EUR 1.2 million for the dividend liquidation exemption or EUR 6 million for the capital gains exemption.
So 10% are high enough purchase price.
Correct. And duration. You need to hold that qualifying stake for an uninterrupted 12 months. You can commit to holding it for 12 months too.
Got it. 10% or 1.26 million held for 12 months. Any changes here for 2025?
Yes, a significant one. For 2025 onwards, there's a new optional waiver for the capital gains exemption.
A waiver. You can choose not to be exempt.
Exactly, but only if you qualify for the exemption based solely on meeting the EUR 6 million acquisition price threshold, not the 10% holding threshold.
Why would you waive the exemption?
Good question. It offers flexibility. Maybe you want to use tax losses you have in the SOPARFI against the gain. Or perhaps it helps manage your position under the Pillar 2 minimum tax rules. You elect this waiver annually per shareholding. Key point. PEX needs 10% holding or minimum price, 1.2 meter divsilic, 6 meter gains, held 12 plus months. New optional waiver for 2025 if only price threshold met.
Interesting. That waiver adds a new layer of planning. What about Lux tax on the acquisition itself? when the SOPARFI buys the shares?
Generally, pretty straightforward from a Lux perspective. Buying shares, no stamp duty, no transfer tax in Luxembourg.
Okay.
The SOPARFI incorporation had that EUR75 fixed registration duty. Might apply again if you increase capital later. Buying shares is usually VAT exempt too. The main tax hit on the sale itself is likely on the French sellers under French tax law.
All right, Lux tax on the Acquisition Act itself is minimal. Now, FDI screening again. Can we just clarify the Lux rules?
Sure. The Luxembourg FDI law from July 2023 targets direct investments by non-UEA investors gaining control, over 25% voting rights usually, in Lux entities doing critical activities.
Like energy, transport.
Exactly. Energy, transport, finance, health, data infrastructure, etc. If it applies, you must notify the Ministry of Economy before closing. They screen it for risks to security or public order.
So for our SOPARFI, buying French targets.
It hinges on two things. One, are the ultimate investors' funds from outside the UEA? Two, is the SOPARFI itself doing critical activities in Luxembourg?
Which it probably isn't if it's just holding French operating companies.
Likely not. But that first point, the origin of the funds, is crucial. Even if the SOPARFI is passive, if non-UE money is behind it, you might need to notify. And don't forget the separate French FDI rules for the target sectors. Key insight. Lux FDI screening focuses on non-UEA investors and Lux entities doing critical activities. Funding source is key, even for holding companies.
Got it. And the new Luxembourg merger control regime, where does that stand?
It's still progressing through Parliament, Bill 8296. The expected thresholds are quite high for Luxembourg. Aggregate Lux turnover over EUR 60 million, and at least two parties each having over EUR 15 million Lux turnover.
So unlikely to affect our specific scenario.
Very unlikely, unless those French targets happen to have surprisingly large independent turnover in Luxembourg itself, which is rare. It's more for bigger deals with a real Luxembourg market impact.
Okay.
But definitely one to keep an eye on as it becomes law.
Okay. Any other key Lux legal or tax updates for 2025 we should flag?
Yeah, a few things. We mentioned the 2025 corporate tax rate, 16% over 200K, 14% up to 175K, and the simplified minimum net wealth tax, likely EUR 4,815 for a typical holding SOPARFI.
Right.
There's mandatory e-filing now for certain withholding tax returns from 2025 directors' fees, wages, some clarifications on taxing share class redemptions as partial liquidations.
Pillar 2.
Pillar 2 implementation is ongoing, that 15% global minimum tax for large M&Es over EUR 750 meter revenue. Probably not directly impacting this specific setup unless it's part of a much bigger group.
Anything else?
AIFMD2 and UCITE's updates are coming, implementation by April 2026, but that's more for regulated funds. Really, the key is staying current with Luxembourg tax circulars, the ACD's guidance, and reporting rules like DC6. There were several new circulars early in 2025 showing things are always evolving. Key insight. Keep tabs on 2025 Lux tax rates, min-NWT, e-filing, and especially official tax circulars for current guidance.
It definitely sounds like a dynamic environment. You need to stay alert.
Absolutely. Continuous monitoring is just part of the game in Luxembourg.
So as we wrap up this deep dive, what are the absolute core takeaways for someone thinking about this SOPARFI route for French acquisitions?
Look, using a Lux SOPARFI can be really smart, tax-efficient, flexible holding structure, but success absolutely relies on super careful planning, diligent execution, and really knowing the legal and tax rules in both Luxembourg and France.
No shortcuts.
None. Getting the SOPARFI incorporated efficiently, then nailing that SPA negotiation, tailoring it for France, and the a constituer buyer status, those are critical first steps. Understanding and meeting the conditions for Luxembourg's participation exemption, including that new 2025 waiver option, is vital for the economics.
And the cost.
Budget, realistically, include everything formation, the much bigger acquisition advisory fees, and the ongoing annual costs for the SOPARFI. Manage the timeline proactively because things depend on each other.
Keep you updated.
Definitely. Keep track of Lux changes, merger control, FDI, tax circulars, and ultimately, you need your Luxembourg and French advisors working together seamlessly. That coordination is key for these multi-jurisdictional deals.
Excellent summary. Really helpful insights guiding us through all that complexity.
My pleasure. It's a common structure, but lots of moving parts.
Hit that subscribe button. It was the Luxembourg Fundcast for you today.